Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value and entertainment out of these videos, all I ask you to hit thumbs up and subscribe. Questions, comments, put those below. I want to touch on a topic this week that keeps coming up. It's recurring. I'm getting a lot of this same commentary, this dialogue. You know, the Bank of Canada, what are they doing? They are doing this massive QE money printing program. They are pricing out a generation of young people out of the housing market, inflating asset prices through the roof. Don't they see what they're doing? Why don't they stop quantitative easing? Why don't they raise interest rates? That would be the surefire way to crush the housing market, to get a rebalancing of affordability. Surely they must see this. But I want to clip to frame this into some comments here from Tiff Macklem, because ironically he was in a conversation this past week with some university students in which he ultimately went on to talk about quantitative easing and diversity and inclusion, which their program certainly doesn't facilitate. But let's clip to Tiff Macklem right here.
One message that came through very clearly from Canadians is they want our policies to be fair for everyone. In responding to the pandemic, we've paid close attention to its very uneven impacts across sectors and workers. We are also looking at how the monetary policy tools we've deployed, including quantitative easing, or QE as we call it, are affecting inequality. Of course, changes in monetary policy always have consequences for both income and wealth. Similar to reducing interest rates, QE works to stimulate demand by lowering borrowing costs and encouraging spending. This supports job creation. And it's clear that the single biggest contributor to reducing income inequality is making sure people have jobs. At the same time, our policy interest rates in QE also affect the prices of assets, and not just government bonds. QE can boost wealth by increasing the value of assets, such as the investments Canadians have in their RSPs or in their company pension plans. But of course, we know these assets aren't distributed evenly across society. And as a result, QE can widen wealth inequality. We will be looking closely at the outcome of QE here in Canada and elsewhere, and we're going to work to more fully understand its impact on both income and wealth inequality.
So Tiff Macklem goes on. He goes on to say, hey, listen, we're creating this wealth inequality, it appears, potentially, but we're looking at it. We're going to do something. But then he goes on later in the interview to actually contradict himself. He says, we're watching the Canadian dollar recently. It's going up a lot. If it continues to go up, we may have to act. We're watching it. But what I want to emphasize here is these two policies don't go hand in hand. You cannot remove QE program at the same time devalue or strengthen the Canadian dollar. So for example, what I mean by that is I had a program, I just did an interview with Pierre Poilievre. I agree with a lot of what he said, like the guy, but the one thing I disagreed with was, he's arguing, hey, the Bank of Canada is essentially doing fiscal, they're basically doing fiscal policy, right? They're basically monetizing the Canadian government's debt. This must be stopped. They're creating this massive wealth inequality, driving asset prices up. It's not good for society. And that's totally true. But his view is that they need to stop this program immediately. And my rebuttal is, well, what happens when they stop? You send the Canadian dollar higher. Why? Because the Canadian central bank is a tiny little central bank. Canada's a tiny little country on the global monetary level. And so you cannot simply stop QE, because we are ultimately hostage to global monetary policy. We basically import what all the other major central banks and governments around the world are doing. So for example, all you have to do is look at the major central banks that actually play a significant role in monetary policy. The central banks that actually move markets, basically. And so, that's the Fed in the US, that's the ECB in Europe, and that's the BOJ in Japan. So these three central banks largely dictate global monetary policy. All we have to do is look and say all three of them have zero interest rate or negative interest rate policy, for example, in Japan and Europe, to see that Canada basically is at the mercy of these central banks and what they do. So Canada can't just start deviating from the global plan and pushing the Canadian dollar up as they start jacking up higher interest rates as a result. And so what you're actually seeing is this basically, again, we try to understand is that all central banks are doing this. And so if we look at the central banks, for example, purchasing or owning a percentage of the government's bond markets, you can see that they are all doing this. Canada is certainly high up in the global scale, but every central bank is owning a larger and larger share of their government debt. They're basically moving ever closer to becoming the sole owner, basically, and directly funding, essentially, these government deficits. And so, we look at Tiff Macklem, he says, well, the Canadian dollar is 82 cents. I need to start watching this. Key you have to understand is this impacts our export market. You can't have a significantly stronger Canadian dollar without dragging down exports and thus dragging down economic growth. And so that's something the Bank of Canada is trying to juggle. On the one hand, you've got QE, which boosts asset prices, which they actually like, and then you've got the Canadian dollar. So they have to juggle these two. They can't just start deviating from the global monetary plan. And so that's what I really want to emphasize is that you have to look at this from a global perspective. You can't just look at it from Canada as its own little island and we just do whatever we want, because I think everybody is well aware that the easiest way, if the Bank of Canada had some, come to Jesus moment and this, suddenly had a moral compass to do what was best for society, I mean, the easiest thing to do would be, okay, well, let's make real estate a little bit more affordable. Let's take at least some of the froth out of the housing market. Let's just push rates up here. Let's go 25, 50, 75, 100 basis points. Let's see what the housing market thinks about that. The problem is again, that's like fairy tale land. In reality, in the real world, that's not how they think, and that's not how this works. And so I just want to caution people, because as bad as I feel for a lot of people that aren't on the housing ladder, or I look at my generation in particular that's basically been priced out of the housing markets, as bad as I feel for them, I want to caution that people that think that governments or central banks are going to come to the rescue and surely they're going to do the right thing and everything is going to be okay. Because I think if you're relying on our policymakers to fix the problem, I think it's the wrong way to look at it. I think that we can't control that, and you almost have to focus on yourself. And this is not to get all sentimental with you, but again, I want to talk about the bigger picture with this, which is what this channel is all about. It's creating that financial education so you can understand what is happening. Now, again, people will say, well, look at the Canadian dollar. The Canadian dollar is going up, right? It's going up. Isn't that great? I thought we were devaluing our currency. What are you talking about, all this QE debasing currency? Well, yes, the Canadian dollar is going up on an exchange rate basis. It's going up against a US dollar that is also being debased. So you're comparing the Canadian dollar to a basket of currencies that are simultaneously also being devalued, right? So, I mean, if you look at it, you could say the Canada's money supply, for example, is up 18% year over year. The US monetary supply is up 24%. So arguably, again, the Americans are basically devaluing their currency at a quicker pace than Canada. So you can't really look at it just on an exchange rate basis. I always look at it and say, well, what is this? what is the Canadian dollar purchasing today? Assets that I want to buy or things that I want to buy, can I buy more of it today or can I buy less of it? And so for me, for example, I like real estate. I like to buy real estate. I can buy 20% less real estate today with the currency that I earn in Canadian dollar terms. That is how I look at it. You might disagree with that, but that's not for me to decide. That's how I am looking at it. And I'm certainly not looking at the Bank of Canada to suddenly have a moral compass and to stop doing, this QE program because, myself or Pierre or a bunch of millennials start griping about it. Because I just look at it and say, we are hostages to global monetary policy. So that's all I got for this week. I want to add that, again, I did an interview with Pierre Poilievre that will be releasing on Monday night. I think that you guys will enjoy it. It was a hard-hitting, jam-packed interview. Lots to digest there, so make sure you subscribe and get notifications for that. And we'll see you next week.